In this video, I want to walk through the Excel template that was embedded in the course, specifically related to transactions. Now, this is not your assignment. However, if you go through these transactions, you'll find that they basically replicate the transactions that you need in your assignment. Therefore, what I would like to do is to spend the next few minutes going through each of these transactions and make sure that we understand what's taking place. Keep in mind that if you see on the bottom, there are several tabs for Chapter 2, which is where we are right now, Chapter 3, and Chapter 4. We will continue to go through these as we go through this course. But I want to focus specifically on the Chapter 2 assignment. This is very similar to the video that I presented. However, there are a few changes, so don't get confused if you are trying to replicate the same numbers that you see in the video. However, the background of this is that we are conducting transactions for the month of May. May is when the business began. Dr. Landry set up this business on May 1st, and we'll go through the first transaction. And then what's taking place is that the business, which is Family Healthcare, begins to complete transactions. Now, what you notice on the top is that we have assets, and we're following the equation where assets equals liabilities plus stockholder equity. We have specific asset accounts. We're not going to be using all of these asset accounts for this assignment, but you get the sense of what it is that we're trying to do. And we will be using the rest of these as we go through the rest of the chapters. Liabilities include accounts payable, notes payable. Some of these accounts we're not going to be using in this chapter, but we will continue this process as we go along. And then finally, stockholder equity. Stockholder equity includes common stock as well as retained earnings. As we've discussed, retained earnings is the accumulated earnings of the corporation since its inception. Common stock is the contributed capital that the owner contributes. So let's go through each of these transactions and make sure that we understand what's taking place. Keep in mind that because we are using the accounting equation needs to stay in balance during this complete process. So what we look at here is the first transaction is Dr. Landry invests $6,000 to start the practice. On May 1st, Dr. Landry invests $6,000. So we are doing this presentation based upon Family Health Center. So what happens is there is a $6,000 increase in cash, and we have common stock that is now $6,000. In this example, we're not going to balance it out after every transaction, but we could. In each of these transactions, the equation stays in balance. So what we have here is assets in the form of cash is $6,000. Liabilities plus stockholder equity is also $6,000, and you see that the account is stockholder equity. The next transaction is Family Healthcare borrows $10,000 from First National Bank by signing a notes payable. So on May 2nd, we, meaning Family Healthcare, borrows $10,000. So if we borrow $10,000, we have now $10,000 in cash. What happens on this side of the equation is we now have a notes payable. We owe this money. That's not $100,000, but that is $10,000. So you notice everything stays in balance. We have $16,000 over here. And on this side of the equation, we have $16,000. So everything is in balance. Let's look at the transaction on May 8th. So on May 8th, Family Healthcare pays $12,000 in cash to purchase a parcel of land. So on May 8th, what's taking place is we buy land, and we buy this land for $12,000. So since cash is going out the door, we have $12,000, a negative amount in cash. The positive amount is going to go into land. So you notice here, and I want to make this point, is that we did all the transactions on the asset side. We did not affect liabilities nor stockholder equity. However, the equation stays in balance because assets stays the same. We have a negative number and a positive number to the asset side. Let's look on May 11th. So on May 11th, Family Healthcare earns a fee or earns fees of $5,500, and these fees are paid in cash. If they earned fees, they generated revenue. Revenue is an increase in retained earnings, and this was paid in cash. Therefore, we have an increase in cash. So on May 11th, what we have is we have $5,500, an increase in cash, and then our retained earnings is going up $5,500. So you notice this side of the equation increased by $5,500. This side of the equation increased by $5,500. Fees earned represents revenue. Revenue increases retained earnings. Let's now look at the next transaction. The next transaction relates to our expenses. In this case, we pay $2,800 for various expenses during the period. Wages, rent, utilities, miscellaneous items. We're not going to put the detail of each of these items. We're just going to put the total. So the total of expenses is $2,800. So on May 18th, we paid these items in cash. So we have a negative balance in cash, and we're going to have a negative entry into retained earnings. Why is that? Retained earnings increases with revenue, decreases with expenses. The net amount, which is net income, is the piece that actually increases retained earnings, but we're posting this individually. So individually, what we've posted is a reduction in retained earnings because of the expenses of $2,800. The next transaction is an example of accrual-based accounting. And this differs a little bit from what you see in the presentation. However, this is an example of exactly what's taking place in the assignment that is due this week. What happens is we have revenue, however, the revenue is on account. In accrual-based accounting, we record revenue when it is earned. We're not concerned with if we receive the cash when it's earned, but once the revenue is earned, we record it as revenue. So the term here, on account, represents the fact that the patient is going to pay us, but the patient is going to pay us at a future time. So on account, because it's revenue, we have accounts receivable. So in this case, on May 20th, we have accounts receivable of $3,000, and the ending balance over here for retained earnings is $3,000. Because we have revenue, it was earned, we have the completion of the transaction, but we haven't gotten paid yet. The patient has promised to pay us, but they haven't paid us yet. But it's an asset, and because it is on account, it is represented as an accounts receivable. So what happens May 25th? Okay, so May 25th, the patient comes back and the patient is able to pay some of the balance. Not all of it, but some of the balance. So you notice on May 25th, Family Healthcare receives $1,800 from a patient on account. So what's actually taking place? Well, we know that we now have $1,800 because someone paid us. Well, what is the additional entry? Well, the additional entry is the patient no longer owes us $1,800. He now owes us $1,200. So what we have here is he, or the patient, we're assuming it's a he, could be a she, pays us $1,200. So at this point, the balance is not, actually pays us $1,800, excuse me, pays us $1,800. So the patient now owes us $1,200, no longer owing us $1,800. Let's just make sure that we understand this. All the transactions occur on the asset side. The equation stays in balance because what we have is we have an increase in cash and a corresponding decrease in another asset, which is accounts receivable. Let's look at the next transaction. Oh, and by the way, I just want to make this point related to this transaction here. We have already recorded the revenue. We did not record the revenue again. So paying an accounts receivable is not revenue. We recorded the revenue when we completed the transaction. We completed the transaction on May 20th. When the patient pays on May 25th, there is no additional revenue. It is simply we receive money and we now have a reduction in accounts receivable. Let's look at the next transaction, which is May 28th. So May 28th, what's taking place is Family Healthcare pays a dividend to its only stockholder, who is Dr. Landry. So on May 28th, we're paying a dividend. This dividend is $1,500. And what we have here is the dividend is a reduction in retained earnings. You see that? So reduction in cash. So our asset side is going down by $1,500. Reduction in retained earnings, liabilities and stockholder equity is reduced by $1,500. On May 31st, Family Healthcare pays $100 interest on a notes payable. We're not paying off the balance, we're paying interest. So on this first transaction related to May 31st is we make a payment. Because we're making a payment, this is a reduction in cash, and we have an expense. And we've talked about the fact that expenses reduce retained earnings. The final transaction, and I think it's important that we make this distinction between interest on the notes payable and paying the notes payable. So what happens on May 31st is Family Healthcare pays $1,000 that is due on the notes payable. Well, the notes payable right now is $10,000. So we're making a $1,000 payment on this, and we're making the payment in cash. So what's taking place here is we have a reduction in cash of $1,000 and a reduction in notes payable of $1,000. So once we've completed these transactions, everything should be in balance. Well, let's see if it is. Okay, so let's do our sum. And we're going to sum everything. So at the end of the period, we have cash of $5,900. Let's scroll this over here. And what you see is the sum for assets is $19,100. Let's do the same thing on this side. And we're just going to scroll this over and see what happens. Okay, so let's just make sure that we understand what's taking place. So on the first notes payable, we originally borrowed $10,000. we made a $1,000 payment, so we now only owe $9,000. Dr. Landry contributed $6,000 in common stock. We see $6,000 balance in common stock. Retained earnings. Again, keep in mind that this is not a continuing operation. This is the first month of operation. So there was no beginning balance. So the retained earnings simply is our net income for the period minus dividends. And that's what we see here is $4,100. We paid a dividend of $1,500. We have revenue of the sum of $5,500 plus $3,000, and we have expenses of $2,800 plus an additional expense of $100. So when we sum these, we should see $19,100. This is not the assignment that you have to do, but this is a practice so that you can get a sense of how all of these accounts work together. Everything that we've talked about is embedded in the assignment, so I don't expect that you to really have a lot of problems with the assignment as long as you watch this video. You may want to watch it a couple of times, but in any event, I thank you very much for your time, and everyone have a great day. The one piece that I will make a point of, and when we come back and look at chapter 3, which is the next month of transactions, is that the balances as of May 31st are going to transfer over to the beginning balance of June. Again, because this is the first month of operation, there are no beginning balances. But the ending balances are going to transfer over, and we're going to see that when we go to the next presentation. Thank you very much for your time. Everyone have a wonderful day.